Welcome back to the Deep Dive. Today, we're digging into Trane Technologies' Q3 2025 performance. And it's really a fascinating picture.
It really is.
You've got this company showing solid growth overall, really good visibility looking forward, but at the same time, they're battling some, well, frankly, brutal headwinds in certain markets.
Yeah, specifically residential and transport. It's quite the contrast.
Exactly. It feels like strong core performance is kind of masking some serious weakness elsewhere.
That's the nut of it, absolutely. And that's why we're doing this deep dive, right? To give you the shortcut to understanding how this all fits together.
Okay.
How did they grow revenue? Why are margins going up? And what's the deal with their capital deployment? They're spending quite a bit on buybacks and these big sustainability pushes. How does that set them up for, not just Q4, but looking into 2026?
Right. Let's jump right in then. Consolidated scorecard first. The headline number looks pretty good. Organic revenue up 4.0% in Q3.
Yep, 4.0%. And total reported revenue, that was up 5.5%.
But drilling into that 4.0% organic number, where did that really come from? It wasn't mostly volume, was it?
No, not at all. And that's like the first really critical thing to grasp here. It was overwhelmingly pricing.
Really?
Yeah. Of that 4.0%, a huge 3.3 points came just from price increases sticking. Volume was only 0.7 points.
Wow, so that's like an 8-to-1 leverage on price versus volume.
Exactly. It tells you they've got serious market power. Even if demand wobbles, they can pass on costs. That's a big advantage right now.
And the margin story alongside that is, well, it's pretty exceptional. Gross profit margin expanded 60 basis points in the quarter.
60 points, up to almost 37%. And year to date, it's even better, 90 basis points expansion.
So how are they pulling that off with inflation still being a factor?
It really comes down to execution. Good operational work, what they call gross productivity, plus that pricing power we just talked about, is more than offsetting inflation and those higher costs like spot buys and expedited freight that have been hitting everyone.
Okay, strong margins, but we also know they're spending money. SG&A costs, selling and administrative, those are going up. Is that a worry?
Well, they're going up, but it's intentional. These are planned investments with, supposedly high ROI.
Like what?
Things like factory automation, digital tools, beefing up the sales team, plus some M&A integration costs. But here's the interesting part.
Okay.
Even with that extra spending, SG&A as a percentage of revenue actually went down year over year in Q3.
Ah, so they're spending more dollars, but it's a smaller slice of a bigger pie. They're managing it well.
Extremely well, it seems. And they're also being proactive where they see weakness, like trimming corporate costs.
Yeah, I saw that. They updated the full-year guidance downwards for corporate overhead.
They did, brought it down to about $290 million from roughly $315 million before. And they explicitly said that's because of actions they took reflecting the softer residential market. They're not just waiting around.
That seems smart because the sources are definitely pointing to some real measurable headwinds hitting in Q4. Can you break those down?
Sure. If you add it all up, it looks like around $300 million in combined pressure for Q4.
Okay, where's that coming from?
About half of it, $150 million or so, is just continued softness in residential. No surprise there.
Right.
Then there's about $100 million that's basically just timing. Some commercial HVAC deliveries in the Americas got pushed from Q4 into early 2026.
Okay, so that revenue isn't lost, just delayed.
Exactly. And the last piece, maybe $50 million, is from lower transport forecasts, specifically from ACT.
Hold on, ACT, refresh my memory.
Oh, right, ACT Research. They're kind of the go-to industry forecaster for the North American truck and trailer market. So when ACT lowers its numbers, it directly impacts the outlook for Thermo King, Trane's transport refrigeration business.
Got it. Okay, that makes sense. And that leads us right into the segment performances, the big contrast you mentioned. Commercial HVAC, the CHVAC business, is the giant, right? Over 70% of revenue.
Yeah, it's the engine. And its performance, especially in the Americas, is just, well, staggering.
How staggering?
Record bookings and revenues in Q3. Bookings were up around 30%. Revenues up low teens.
30% bookings growth.
Still. And look, longer term, the 3-year stacked revenue growth is over 50%. And for applied systems, those are the big, complex, long-cycle projects. The 3-year stack is up over 125%.
125%. That's not just a blip. What's driving that kind of sustained demand? It can't just be pent up everything forever.
No, it's broad-based across their key high-growth areas. Data centers are huge, obviously, but also education, government, healthcare, Really strong demand there.
And it's not just an American story.
Not at all. Asia Pacific had a great Q3 too. Organic revenue up 9.3%, and that was mostly volume driven, which is interesting.
Mm-hmm.
China specifically saw CHVAC bookings jump almost 80%. Revenues up about 20%. Now, some of that was easier comparisons to last year when credit was tight, but still strong numbers.
Okay, so CHVAC is firing on all cylinders.
Mhm.
And this backlog they keep talking about, that's the key piece for looking ahead, isn't it?
It's absolutely the strategic asset. The backlog is still really high going into 2026. And crucially, over 90% of it is that CHVAC business.
And mostly the long cycle stuff.
Mostly the longer cycle applied systems. And here's why that's doubly good. Those applied systems have this really valuable high-margin services tail. Maintenance, parts, upgrades over the life of the equipment.
So the sale is just the beginning.
Pretty much. That massive profitable backlog, it's like a built-in shock absorber against short-term bumps, gives them incredible revenue visibility for the next, say, 12 to 18 months.
Okay, so that's the powerhouse. Now let's slip to the segments that are acting more like anchors right now. Residential and transport, Resi was down significantly.
Yeah, significantly is the word. Bookings down about 30% in Q3, revenues down around 20%. It's rough.
Why so severe? What's the story there?
It's kind of a mix of things. Partly cyclical, you've got high inventory levels in the channel that dealers need to work through.
Okay, that makes sense.
But there's also a structural element with the regulatory changes around refrigerants. This whole shift away from high GWP global warming potential refrigerants. It's making people hesitate, making decisions complex.
So channel partners and homeowners are maybe pausing before they buy.
Exactly. That uncertainty is definitely a factor, and they expect that weakness to stick around through the end of the year.
Okay. And transport, Thermo King. You mentioned the ACT forecast pressure.
Yeah, the overall transport markets are definitely feeling the pressure. ACT cut that full year 2025 North American trailer forecast way down to about 25,000 units. That's a drop of roughly 30% year over year.
Ouch. So how bad will that hit Trane in Q4?
Well, here's where it gets interesting again. Trane is actually forecasting the overall transport market to be down about 30% in Q4.
Okay.
But they expect their own transport revenue to only be down around 10%.
Wait, market down 30, they're down 10. That sounds pretty good, actually, like they're grabbing share.
It absolutely implies strong market share gains. It prints to their execution, brand loyalty, maybe technology leadership in that tough environment. But stepping back, the analysis really suggests this is a cyclical low point for transport. ACT is actually projecting robust growth starting next year in 2026.
Oh, really? How much?
They're forecasting around 20% growth for the trailer market in 26 and then continued strength through 2030. So the feeling is, yeah, the market's kind of bottoming out right now.
Okay, bottoming now, rebound later. Let's shift gears slightly. Beyond operations, look at cash flow and capital deployment. Their cash generation looks, well, incredible.
It really is. Cash flow conversion in Q3, 109% of adjusted net earnings.
So they generated more cash than they reported in adjusted profit.
You got it. And for the full year, they're on track for free cash flow to be at least 100% of adjusted net earnings, maybe more. That kind of conversion just gives them enormous financial firepower.
And they're deploying a lot of it. The target for 2025 is what, $2.5 to $3.0 billion total?
That's the target range, yes.
Yeah.
Big number.
So how does that break down? How are they balancing returning cash to shareholders versus investing for growth?
It seems like a pretty disciplined, balanced approach. First, returning cash. They bought back about $1.25 billion worth of shares through October this year.
Right.
That actually used up their old 2022 authorization. But they've got a new one from 2024 with $5.0 billion still left on it.
$5 billion, that's huge.
It is, and they say they use it when the stock looks cheap compared to their own calculation of its intrinsic value. Plus, they boosted the dividend 12% back in February. It's up 77% since they launched as Trane Tech in 2020.
Okay, so serious returns to shareholders.
Mm-hmm.
But what about growth investment, M&A? We heard about BrainBox AI.
Right. That's the other side of the coin. They've spent about $160 million on M&A so far this year, and BrainBox AI is the standout. It's an AI company focused specifically on optimizing HVAC systems, very future-focused tech play.
So it's interesting. What's the financial impact right now?
Well, right now it's actually a drag on earnings. They expect M&A overall, including BrainBox, to hit EPS by about $0.20 this year.
20 cents negative. So it's dilutive in year one. Why do it then?
Because it's strategic. You've got integration costs, maybe some accelerated amortization hitting the books now before the revenue really kicks in. But the plan, the expectation, is that these deals will be accretive, adding to EPS by year 3. It's a bet on future growth and tech leadership.
Investing now for returns later, that theme of stability and long-term thinking seems to carry over to their services business too, right? That's a big chunk of the company.
A very important chunk, about a third of total revenue. And yes, very stable. It grew low double digits again in Q3.
And consistently.
Oh yeah, it's delivered a low teens compound annual growth rate, CAGR, since 2020. That recurring revenue is just incredibly valuable, provides a buffer when equipment sales get choppy.
Okay, let's zoom out one last time. We've talked about the segments, the finances. What about the big picture? The macro forces really driving that huge commercial HVAC demand. This isn't just a good quarter or two. It feels bigger.
It absolutely is bigger. There are major secular tailwinds underpinning this. Think decarbonization goals and regulations, the push for energy efficiency, urbanization driving building needs, and of course the focus on indoor air quality, IAQ.
All long-term trends.
Exactly. And these trends often lead to large, complex, multi-year projects, which plays right into Trane's strengths with those applied systems and their deep backlog.
And they're leaning into this with their own sustainability goals, like the Gigaton Challenge.
Right. That goal, cutting 1 gigaton of CO2 equivalent emissions from their customers' operations, is a huge statement. It's not just marketing, it helps them win those big contracts.
Is it credible?
Seems to be. They have a 2050 net zero target validated by SBTI.
SBTI.
The Science-Based Targets Initiative. It's kind of the gold standard for corporate climate goals. And they're showing progress. They hit an earlier emissions reduction goal, the 25 by 25 initiative, ahead of schedule. So sustainability isn't just a side project. It's baked into their innovation, like with their thermal management systems, and it's seen as a growth driver.
Okay, this has been quite the deep dive. Lots of moving parts here. If we had to sum up the critical takeaway for you, the listener.
I think it's this. Trane is using the incredible strength, the predictability, and the long cycle nature of its commercial and services businesses to basically power through the short-term cyclical downturns hitting residential and transport right now.
So disciplined execution where it counts.
Yeah.
Using that strength to weather the storm elsewhere.
Precisely. High visibility from that massive CHVAC backlog, effective pricing to combat inflation, and that steady focus on high-value decarbonization projects. It all suggests that even though resi and transport might be, bottoming out, the bigger structural growth story, growing faster than GDP, that seems very much intact.
A powerful summary.
Okay,
Before we wrap up, a final provocative thought for you to mull over. We talked about the M&A, especially BrainBox AI. It's dilutive now, costing them earnings per share, but the bet is it adds value later. So here's the question. As that AI technology potentially makes HVAC systems way smarter, way more efficient, does Trane basically become more like a software company that happens to sell hardware?
Interesting angle.
Or does embedding all that complex AI just open the door for new competition? Maybe pure-play tech companies looking to disrupt the traditional HVAC industry from the software side.
That is a really interesting strategic question to think about, especially as we head towards that expected market recovery in 2026. How will it all play out? Something to ponder.
Indeed. Thanks for joining us for this deep dive.
My pleasure.
We'll catch you next time.